Andrew, thanks for joining us.
Pleasure.
So tell us a little bit more about ALE.
ALE Property Group was first established in 2003. It came out of Foster's. Foster's had a very large pub business. It sold the pub properties into ALE, the property trust that now owns it, and it sold the pub businesses into ALH, which was just a year later in 2004 acquired by Woolworths and Bruce Matheson for around 1.3 billion. Now at that time, the ALH business was around 135 hotels. Today, more than 330 hotels, turning over more than $4 billion a year.
That's huge. From my perspective, one of the things that our readers are asking us is, what are the impacts that are at a macroeconomic level and probably even a political level that are impacting the REIT market?
Yeah, I mean, as one tries to look through a crystal ball into the future, it's difficult, but if I think about what the factors that would normally affect a property market like ours, particularly the commercial property market, I'd focus on a couple of things. Firstly, interest rates and inflation rates. If they were to move higher, and potentially if they were both to move higher, then I would expect that would to have a fairly moderate impact on the commercial property pricing and valuations. If interest rates were to rise on their own, I'd expect that to have a more severe impact on commercial property prices. But we, with our long-term leases to ALH across our 86 properties, we are hopeful that inflation would rise with interest rates and that would have a less of an impact. The other issue we focus on is the credit markets. Credit markets in Australia at the moment are fairly good shape. There's been significant bond issues over the last couple of years and in recent times at very effective prices. So if the capacity and the pricing of that market continues, we'd see that being fairly positive. And the other factor I'd point to is geopolitical matters. Yeah. Here in Australia and beyond, they have the potential to make the market bigger or smaller depending on how those play out.
And so do you see that as one of the bigger factors in the next 12 to 24 months for the REIT market generally, as opposed to just for ALE?
ALE receives 12 rent payments a year from ALH. We'll continue to do so over the next 11 years, and with ALH extending their leases on the properties potentially for another 50 plus years. So we are probably at the more passive or less risky end of the sector. We're not concerned about massive releasing risks or development risks or things like that. So we would expect interest rates won't impact ALE as much as perhaps others. For example, we have 8 years of interest rate hedging on 100% of our debt. And that's very positive, and I would argue probably one of the most proactive and least risky debt positions of any A-REITs in the market.
Yeah, definitely. It sounds like you've insulated yourself against some of those bigger, more macro-related risks. Are there operational factors that influence ALE and that you should be aware of, I suppose, when you're running your business?
I mean, from an operational perspective, we focus on working closely with ALH. We have nearly 1 hectare of land across the 86 properties that we own. Those properties are 25% occupied by pub buildings. Yes, there's lots of car parking around the pubs, and that'll continue to be required. But we work hand in glove with ALH to add Dan Murphys where it's appropriate and or develop the properties for the operational benefit of the tenant and for the longer term growth and rental prospects for ALE as the landlord.
Yeah, so effectively ALH's concerns, risks, things that they are dealing with have an impact on you indirectly then?
Yes, our future market rents, we have market rent reviews in 2018 and 2028 and each 10-year anniversary thereafter. At those points, our market rent is realigned with the earnings of ALH, and they've been doing a fantastic job adding improvements to the site, spending hundreds of millions of dollars on their capacity to increase earnings. So it might be a refurbishment of the Crow's Nest Hotel, and that's being completed in the last year or so. Or it might be the addition of a Dan Murphys, that also adds to the earnings. All of those things are helpful for ALE's future market rent prospects.
Yeah. Sounds like ALE have got a lot of these things covered. Are you seeing other risks in the REIT market generally that other real estate trusts should be aware of or should be grappling with? I wouldn't mind your opinion on what some of those issues are.
I mean, more broadly, can I say the rest of the A-REIT market manages itself very well. They do face different risks from the ones that we face. Some of them are more actively exposed to the economic cycle. From ALE's perspective, we're almost counter-cyclical. Indeed, if we go back to the last GFC, we saw that probably the best of times was when things were tough and governments wrote cheques and sent them to households, and they invested them wisely at supermarket groceries, in some cases some entertainment at our hotels. But can I say, we tend to be fairly steady through the economic cycle compared to others, and yes, we see that maybe the opportunity for others to benefit from significant upswings and perhaps be more exposed to any downswings at some point in the future.
So, Andrew, you've told us a little bit about the A-REIT market and also, I suppose, where ALE sits. In terms of the investment spectrum and where a REIT product sits, can you give us a little bit more colour on where you see that and where you see ALE? Perhaps
if I talk about A-REITs generally, at one end of the spectrum you might have fixed interest or cash, which is sort of less risky and potentially lower return. And at the other end of the spectrum you have very high risk speculative equity stocks. If I think about where A-REITs sit, they're probably more down the fixed interest end of the spectrum. They have some additional risks over and above fixed interest. In other words, you don't get your money back after 3, 5 or 10 years, whatever the bond term might be. But you avoid risks like inflation. Property or commercial property A-REITs have an inflation protection generally built into them, and in ALE's case, if I think about where ALE sits in the A-REIT spectrum itself, we have long-term inflation index cash flows. We have a tenant who's doing a very good job of operating the hotels. Our rents increase annually by CPI, but there are market reviews where we potentially catch up to where they are trading, and they've been doing a very good job in making the hotels more profitable, and therefore our market rent prospects for future years going forward.
I think from our readers' perspective and what we're hearing from our global counterparts is they're really keen to understand what are the key drivers as to whether the REIT market in Australia will contract or expand in the next 18 months or so. Do you have a view on that, Andrew?
Over and above all the normal things that might affect pricing, like interest rates, inflation rates, credit markets and geopolitical things, all of which may make the index and the volume of the index even higher or lower. Over and above that, there's opportunities for consolidation. We've seen a certain amount of activity in the market this year where one trust might be taking over another. We haven't seen much IPO activity. Maybe that'll change in the future as the market dynamics allow, but that'd be the two main swing factors I would see going forward. Potentially further consolidation, and hopefully if the IPO market comes back, we might see new portfolios of property being brought to the market and diversifying the range of things that investors can invest in.
Andrew, we're seeing a number of our clients looking at offshore US type debt markets. What's been your experience with the US market?
Well, we actually went to the Australian corporate bond market in March of this year and issued $150 million for 5 years. We did look at the US market at the same time, but what we found with the US market is they tend to prefer 7 to 10 year tenor. And we had a preference for 5 that suited the rest of our debt book, and we found the Australian bond fund managers who know ALE well and have stuck with our credit very consistently over the last 14 years. They priced a very competitive bond for us, and we were very pleased with that outcome. That said, in the last 6 months, we've seen the US market for credits like ours become far more competitive and are very close to being pretty much line ball with the Australian bond fund managers. So we, in the future, will consider US private placements and other bond issues in other markets. But at the moment, the Australian market's looking after us very well.
Thank you very much, Andrew. That's been really illuminating. Thank you.
Thank you.